Hi everyone and welcome to today's morning report on Friday the 6th of May with me, Rich Perry, market analyst at Hand Tech Markets. Yes, it is Friday and it is Non-farm Payrolls Friday. And the markets are slightly lower. Bit of caution flooding through the equity markets today. Nothing too significant in terms of losses. FTSE about 0.5% lower, and the DAX as well. But on forex markets, it's sort of broadly flat as well. The majors sort of looking at the euro just slightly higher, sterling slightly higher, yen slightly also slightly stronger. But there's sort of the flip side of that is you've got the commodity currencies which are pretty much weaker. You've got the Aussie dollar, which is sharply lower, actually 1.25%, and the Kiwi dragged lower with it. The Aussie lower on the report, or sorry, on the RBA cutting its inflation outlook, and the Aussie has been punished on the back of that. It's interesting because the dollar strength that we had, or that we have had in the recent days, in the recovery of the dollar back towards this sort of resistance around 93.6 on the dollar index, you're not really seeing that recovery on the on treasury yields. So you've had this dollar strengthening all the while that treasury yields are still falling. So I think that's a little bit of an odd dichotomy there that's going on in the market, and you got this sort of settling now ahead of payrolls that you're likely to get through the day. Payrolls report tends to be that the early European session is fairly muted in front of that key data, and then you start to see an explosion of action afterwards. Watch out for the spike. I always say this: watch out for the spike on the result announcement, because the algos react instantly, and then you get a little bit of you can quite often get a retracement of that move. So just be careful of that today. Now, in terms of what the payrolls report expectations are, it's 202,000 is the expectation on non-farm payrolls, so slightly down from 215. The question marks surrounding the ADP report and the impact that could have on payrolls. ADP came in quite significantly below estimates on Wednesday, about 40,000 jobs below the below the estimate. At 156,000 was the actual. So that sort of lays the question marks over to whether payrolls can actually hold up again above 200,000. Also, you've got unemployment rate around about 5% is the expectation there, so sort of holding where it's been pretty much for the last 6 months. And the the labour market participation rate, now that has been rising pretty much for the last 6 months, and a continuation of that rising would suggest that the labour force in the States is strengthening, and that is obviously shows a strong outlook for the labour market generally. Not only that, we're expected to see 0.3% on the average hourly earnings as well. That would actually mean that the year-on-year data would tick up to 2.5%. So you're beginning to see the sort of signs of some traction in wages in the States. Nothing too significant, but certainly the improvement in the labour force participation rate sort of all ties into this sort of gradual improvement in labour market hourly wages. So that is the report. That's at 1:30 today, and take the report as a whole, I would, rather than just looking at the headline numbers, because average hourly earnings and participation rate are very important for the FOMC. So that takes me to my chart of the day, which is the Aussie dollar. Now, the Aussie dollar, as I said earlier, has been under pressure. It's been under pressure actually since we first had the inflation data coming out worse than expected a couple of weeks ago. That produced the initial sell-off. Then the RBA cut rates last week. Oh no, sorry, this week. Sorry, I'm being silly. This week, RBA cut rates by 25 basis points. Big negative candle. That sort of broke that uptrend, and then subsequently overnight, we've seen the RBA again sort of cutting its inflation expectations. So the Aussie is under increasing pressure. And looking at the technical indicators, you can see why. The Aussie RSI is at its lowest level since mid-Jan. MACD line's similar story, beginning to turn negative. The stochastics are the most negative also since mid-Jan as well. So really is turning into a corrective outlook, or even a possibly negative sort of outlook. Now you're back below 73.85, which was your old breakout key level. That was an old key breakout, 73.85. You're back below that. That now takes you to sort of the next support lines. You've got a minor. Let me just get the crosshair. Got a minor support there at around sort of 73.23, I think it is. Sorry, 27. And then you're sort of back into the February highs, I think, ultimately, which is probably where we're coming back to now, sort of 72.50 area. I think that's around about where we're sort of retreating back to. It seems to be that the correction in the Aussie is sort of gathering momentum. Certainly the RSI, MACD lines and stochastics all falling into negative territory. The outlook on the hourly chart is that you'd be selling into strength, I think, and you've got the resistance overhead that comes in at around 74.50. That was the old lows from Wednesday, Thursday this week, and also the highs from that is 75.16. So it's a pretty decent sort of level of sort of sell zone I think you'd get if you saw a weaker than expected payrolls number today that possibly induced a bit of a technical rally. I think technical rally would be sold off on this Aussie now. I think the outlook is increasingly negative, certainly near term. Look at all the moving averages falling on the hourly chart. And the outlook, I think, is under pressure now. So rallies are a chance to sell on the Aussie, and I think there's going to be further weakness in due course. So I wish you good luck in your trading today around payrolls, and I'll speak to you later. Thank you.